Hi, everybody. Thank you so much. Also, thank you, Christian. You're looming over us, behind us on the cinema screen. So welcome, everyone. We wanted, as was mentioned, really to talk about Bitcoin and the role Bitcoin can play in the economy and some of the technological evolutions around Bitcoin, which make this interesting. Maybe what I'm going to do is I'm going to start and do a little quick introduction for Bitcoin, because Bitcoin isn't here in person, and then maybe we do a quick round robin. We heard what you all do, but it'll be good to understand in a little more detail what your respective roles are and what you really care about currently in the respective companies you operate in, and then we'll talk about the sort of organic flow of payments, monetary movements, some of the DeFi development of Bitcoin. But as a reminder, Bitcoin is now, I want to say, 16 years old. We have around 20 million Bitcoin in existence. There's 1 million outstanding to be minted. We're assuming, I don't know if my math is correct, somewhere 2040 would be the time when the last Bitcoin gets minted. Currently, we mint, or the network mints 6 Bitcoin every 10 minutes. There's around 50 billion in payments or transactions, whatever they're used for, per annum, per day, moved on Bitcoin, which is larger than Visa or MasterCard individually. There's over 200 million holders of Bitcoin in the world. And a year, 2 years ago, El Salvador started using Bitcoin as a reserve currency. So we don't want to give you any ideas, but we do want to mention it. And so Bitcoin's been really at the forefront of the cyberpunk movement. Initially, really started with this idea of giving everyone simple access to actually payment and money rails, right? And so there's still a firm belief and a firm core development ethos that works along those lines. Now, so why don't we start with, why don't we start with you, Rachel? Just quick introduction, your background, and what you do at Anchorage and Anchorage in general.
Sure. Can everyone hear me? Okay. Hi, everybody. My name is Rachel Anderika, and I'm the head of global operations at Anchorage Digital. So what is Anchorage Digital? We are a regulated platform for institutions providing custody, trading, et cetera. We've done this through various licensure, and the crown jewel of our corporate entity is our OCC chartered trust bank. So one of my jobs is to oversee all operations of the trust bank and to kind of like interact in the regulatory sphere. My background, proudly, is I started my career as an OCC bank examiner. So very, very familiar with the regulatory process and what is expected from a supervised institution. Went from there into the regulatory consulting space, where I did a lot of licensure work, particularly in the Fintech space for Fintechs who wanted to take advantage of licensure where it was available. And that's how I came to be at Anchorage. So grateful to be here, and yeah, thanks for having me.
Yeah, Paul, you want to go next?
Good morning, everyone. My name is Paul Grewal. I am the Chief Legal Officer at Coinbase. Coinbase is a global cryptocurrency platform. We offer trading, brokerage, custody, and a variety of other services in order to power what we believe will be a crypto-based economy heading into 2025 and beyond. In my current role as the Chief Legal Officer, I am responsible for our various efforts to get regulatory clarity here in the United States and around the world. Those efforts take many forms. We are eager for legislation to move through the Congress. We are certainly eager to see rulemaking at the appropriate agencies. And yes, on occasion, we do find ourselves in federal court as well. It's a pleasure to be here with you all.
Andrei?
Thank you. It's great to be here. Great to be back in Philly. I got my PhD in economics at the University of Pennsylvania, so it's great to be back. I'm really, really, really pleased with what I got. And what I learned, probably about 90% of what I learned pretty much from just one man who became my PhD advisor. And what he was an awful advisor. He he single-handedly created 3 subfields of finance. Pretty much all of his co-authors have won Nobel Prizes by now. His name is Sandy Grossman. He was an awful advisor in that you need to make appointments with him, and he could only read what you give him, and you had only 10 minutes to explain. And so the way I learned from him, I learned to reverse engineer his thought process, because he would be reading and then he would stop and say, I don't understand from here, and hand it back. So, and you have to figure out why doesn't it understand. And so from that, I learned finance, and I started approaching finance as something that you have to reverse engineer. You have to figure out why something that is working is actually working, and something that breaks down actually breaks down. So I joined the IMF working on financial crises around the world, just to see when things break down, like how do they break down? Like what is it that that in finance doesn't work? And then I joined the CFTC after the global financial crisis to work on the redesign of the financial system. And then my colleagues from academia said, look, you have a lot of things in your head. You need to come back and start teaching students and write papers, because it's in your head, it needs to come out. But Bitcoin was a direct response to the global financial crisis, actually written into that. So this is a response of things not working out. And I think it's very important for us to remember that that is how it came to be. And it has somewhat evolved in its use, but it came to be as an alternative, as an underdog, as an opportunity, as something, as a response of something not working out. And I think we can continue harness this power from that.
No, that's great. Thank you. Christian.
Catalini. I started my journey into crypto around 2011 as an academic. In 2013, we did the Bitcoin experiment at MIT, where we dropped, at the time, $500,000 in Bitcoin to all of the MIT undergrads. And that was really my foray into the unexplored field of economics and crypto, very much considered a fringe, maybe to this day, by many academics. That led me to becoming one of the founding members of the infamous Project Libra, so engaged with regulators across the globe in trying to get off the ground what was probably too early ecosystem for stablecoins on a global scale. And when we threw in the towel after Libra, we went back to the drawing board and still trying to really solve for low-cost global cross-border payments. So we're working on it at Lightspark, and we're building on top of Bitcoin. And I'm sure we'll talk a lot more about our choices for that network and that asset.
Thank you, Christian. I do a very, very brief blog on Blockdaemon and myself. Blockdaemon is the largest node operator in the world. We run around 220,000 nodes for 80 different protocols and 70 different data centers around the world. We're really, I like to describe us as the largest crypto company you've never heard of. And that's partly by intent. We really want to be the backbone for institutional rails, basically. We are, as far as I know, the only crypto company that has 3 of the top 10 financial institutions with a major shareholder denomination, which is JP Morgan, Goldman Sachs, and Citibank. Our customers include those, as well as the Fidelities, the Bank of New York's, the PayPals, Robinhoods, and so forth. And so we're never hold custody. You know, we're a pure technology provider, and so we're a very simple gateway into Web3 for institutions. And we're based in the US, out here in SF, and we're publishing financial audited accounts, are compliant with all laws and regulations, and are really excited to help further the digital asset revolution. So the way we thought about this panel is that we're going to start and follow the money flow a little bit when we talk about Bitcoin. And so I'm going to ask, actually, Christian, you kind of ended with an interesting side note, which is kind of maybe the elephant in the room a little bit, is why Bitcoin for payment? We all heard, you know, Bitcoin as gold. Gold isn't used a lot as payment. And yeah, what is that choice about? And is that the best use case you can think of for Bitcoin?
Yes. Historically, Bitcoin has been dismissed for a number of reasons when it comes to payments. I mean, that was the original idea in the Satoshi white paper. But because of volatility, but also limitations, technological limitations of the network and incentives, we haven't really seen that pan out to this day. Incentives, of course, have been strong to either cloning Bitcoin or extending Bitcoin over the years and launching your own token. We've seen kind of what that has created in this space. But after the FTX meltdown, I think there's been a stronger focus on really delivering actual utility, not only to consumers, but also to businesses. Bitcoin has really accelerated in terms of institutional adoptions. I would say the ETF is, of course, a hallmark of that change. If you look at global custodians like BNY or neobanks like Nubank, it is the first asset that they all feature, and it is the first asset that TradFi firms, as they cross over, expose their customers or their own operations to. With that mainstream adoption, you do really have an asset that has unique properties. The governance and history of Bitcoin has not been replicated by any other crypto asset in this space. Even ETH, which is probably the most relevant contender there, does not have the same stability and progress and the same moneyness of Bitcoin within the crypto ecosystem. But what about the other limitations? I mentioned the technical ones, right? So Bitcoin originally did not scale. That has now been solved, and there are solutions that, as you will see over the next few months, will make Bitcoin scale not only in terms of transaction per second, but also other dimensions that really matter when it comes to global payments. Think about commercial privacy. A merchant will not want their transactions to be publicly visible on a ledger. It is also global, and it has global liquidity. So when you start to think about what is the one asset that is available to me 24/7 that I can move with final settlement in a compliant way, Bitcoin is really the only option on the table. And it has a much tighter spread than stablecoins. Stablecoins suddenly are all the rage. Actually, when we wrapped the towel on Libra, we promised ourselves we would never issue a stablecoin ever again. There's a number of complications when you're trying to issue a stablecoin, including that there's now a central actor that has a lot of market power over that ecosystem. Stablecoins are not like the dollar. There's a gap, and I think until Congress really fills that gap and gives us robust stablecoin legislation, they won't be as good and useful as traditional dollars or deposits. That's where Bitcoin really comes into the picture. It is a special asset that now can move cross-border 24/7. It can connect all these domestic payment rails that have been upgraded really amazingly across the globe. Think about Pix in Brazil, UPI in India, and many other places, maybe FedNow eventually in the United States, and be the glue both at the institutional level and at the retail one between all these different traditional and new assets. So really to wrap up,
I want to interrupt. Sorry, this is super interesting, but I actually have a quick follow-up question because you mentioned some of the key things that would matter in payment. I think one question that will come to mind is, wouldn't it be more expensive or volatile to pay for something in Bitcoin if the price is so volatile? Can you just touch on that real briefly?
Absolutely. So first of all, volatility, as we've seen, has been decaying over time. And with more institutional adoption, of course, the whole ecosystem is maturing. But the key here is not to think of Bitcoin as an asset that you're holding across the transaction. It is a global settlement asset that you're coming in and out of like a pipe really effectively. So now I could go from dollars to Mexican pesos, where I have a tight spread between the dollar and Bitcoin. And in fact, market maker will be really open to accepting that trade because the payment flow is not arbitrage flow, and back out from Bitcoin to Mexican pesos on the other end. Now, there's a lot of efforts from the BIS to others to really connecting, maybe eventually even CBDCs and domestic rails. But those efforts are extremely slow, and there are very strong geopolitical reasons for those efforts to really never fully connect the entire planet.
Great. And so that's super interesting. And maybe one interesting way to think about this is, Coinbase has chosen a little bit of a different path. Obviously, you guys work with Lightning, which is, what Christian is working on. You've also established another L2. If we, take here, like what we talked about is solving this sort of transaction issues, building layers upon layers that allow you to push through, thousands of transactions per second. Coinbase a year ago started Base, which is based ultimately on the Ethereum stack, in order to bring all their physical, payments and settlement onto the digital asset world, basically. Can you talk to us about what you see the main use case there is, and how does it differentiate itself from something like the Bitcoin network?
What we have been tremendously pleased with the progress we've seen with Base, even in relatively short order. I think it's fair to say at this point it has emerged as one of the most significant L2s in the market. Whether you measure that by total value, whether you measure that by developer activity, transactions over the network, it is remarkable that in just a handful of months we've now seen Base really offer, I think, a range of services and technologies to support on-chain development and adoption, perhaps most notably with respect to payments. And so our strategy has been one of all of the above. We think that Base can address some of the scaling challenges that Christian has rightly called out with historical networks. A key question, of course, to addressing scalability is how do you enhance transaction processing to the point where the costs of transactions are measured not in dollars or tens of dollars, but in pennies. We think we can solve that problem with Base. But I also want to underscore this idea of an all-of-the-above strategy, because I do think it's important to understand that Bitcoin does offer, for all of its limitations and challenges that Christian and others are going to overcome through their great work, it offers some unique attributes and strengths that no other digital asset can yet match. And here in the United States, what I'm referring most of all to is its regulatory certainty. The fact of the matter is, even as the current Securities and Exchange Commission has taken the view that essentially all or nearly all digital assets qualify as the objects of securities transactions, the SEC has grudgingly perhaps, but clearly acknowledged that Bitcoin stands alone as something outside of its purview. The ETF approvals, the ETP approval that we saw over the last year, again, grudgingly granted in the face of a circuit court opinion declaring that their refusal to approve these ETPs was arbitrary and capricious. That same SEC acknowledged that the Bitcoin ETPs were required under law, and so granted those approvals. And so I underscore these points to simply acknowledge that the regulatory clarity and certainty that Bitcoin brings to the payments conversation does distinguish it, I think, from many other networks and technologies that will operate alongside of it. Whether that advantage will endure into 2025 and beyond, I'm skeptical, but for the time being, it has to be respected and at the very least acknowledged. And that is why, among other reasons, even as we've pursued Base and many other technologies that we think will expand the range of options available to consumers and merchants and others in the payment space, Bitcoin remains an important element of the equation.
Thank you. Rachel, following on from that, so Bitcoin has obviously been pushed more into the institutional limelight this year. Can you talk to us about how you see that occur? Do you see more inflow from institutions around Bitcoin? What's been the reaction to that in the market?
Yeah, sure. I mean, there's obviously been, so I guess last October, I was invited to a panel at the Greenwich Economic Forum, and the whole premise around that panel was that institutions are back. And I remember the moderator came in and she was like, I don't think institutions are back. And our whole point was like, yes, they absolutely are. And so, from an institutionally led, market run, what we've seen is, kind of twofold, right? Obviously, there's a place for Bitcoin in an institutional portfolio, and that's been widely recognized. And what we've been building at Anchorage has really all been around institutional adoption, and that is by far led with Bitcoin, because Bitcoin has the most international liquidity, the most support for it, and it's the most recognizable. And so, but as goes Bitcoin, so goes like the rest of innovation, right? And so, like when you look at our assets under custody, we have probably for the first time ever close seconds in Bitcoin in holdings of other assets, and that's really like a function of like how the how the innovation sector tends to work in digital assets. But I'll say that, institutional adoption is extremely important to drive this forward. I don't think that you would see a light spark happening if there weren't institutional adoption kind of leading the way towards innovation, right? And so there's when I see the market, there's two broad things, right? There's the institutional speculative use case, which is not a bad use case. And then there's the payments use case, which kind of builds on top of it.
Interesting. And Andrew, I'm so interested in hearing your assessment specifically with your background in regulation and academia. Do you think the current ETF sort of push around Bitcoin should change how, for example, central banks are thinking about their respective reserve exposures? Do you think there's a role for Bitcoin to play in actually the government managing and holding assets over time?
Interesting. Let me take this question into two parts. First is just the ETF, and the second part is sort of the reserves and other things. So ETFs, I've done a bit of research on ETFs. So ETFs, just the most interesting part to me about ETFs, and this is the part that was sort of sold for Bitcoin. As you know, Bitcoin over periods of time is in fixed supply. So remember your, economics 101, it's a vertical line. And so all the fluctuations in price that happen because the demand curve just slides up and down. And so the prices are just going up and down in a very volatile sense. If your supply curve becomes elastic with respect to price, the price is not going to be moving as much. And so what ETFs do, and that's what they're designed to do, is that these are what's called assets and variable net supply, meaning that supply responds to demand. If there is more demand for ETF shares, more ETF shares are created by the sponsor. If there's less demand, shares are taken out, right? And so by this response, what you can do is that you can dramatically reduce the volatility of the price around it because quantity responds. The price doesn't need to go all the way up and all the way down. So that's why, sometimes when people call Bitcoin digital gold, commodities in particular have that feature because over short periods of time, their supply is inelastic. And so they just go, right? So ETFs are interesting. So they're solving the problem. They're attracting very interesting investor base. Last time I looked, I think Chief Investment Officer from BlackRock came out and said 80% of the people who hold their Bitcoin ETF are like they've never seen them before. These are like new people who are coming into this market. So it's like opening up the space to those who were not there before. Good thing, right? Potentially good thing, right? Because otherwise, their money is not being put to use. Participates in price discovery. You see what these prices are. Regulated instrument, well-known, response to supply. All of that is sort of moving. There's an issue potentially with Bitcoin ETFs that flies completely in the face of what Bitcoin is supposed to be, and that is ETFs, as you know, run on authorized participants. There's an authorized participant who is intermediary in there, in between the sponsor and the public. And so these authorized participants, are authorized. There are not that many of them. You have to be authorized. It's an oligopoly. There's a handful of them. And a large number of them are high-frequency traders. So they're just sort of machines. They're going to shred. So they don't take any responsibility for anything. They're just there to do what they're supposed to do. So you've introduced the machinery that potentially could lead to systemic issues. The Federal Reserve Board had to step in and say, we're going to provide the backstop to fixed income ETFs because mispricing went sort of through the roof. So you're solving one problem, you're creating another problem. I'd give it a wait just to see how the thing matures. I mean, there's some positive signs to me about what ETFs are doing to this market. In terms of sort of going all the way into the end of your question, I'm not quite there yet. I don't know, does that make sense,
Yeah. That makes perfect sense. And then, so if we take it to the other end, we touched on gold. Actually, want to torture Christian with this since he's thinking about payment. What do you think about Bitcoin as sort of a version of digital gold? Like, what is your view on that?
I believe Bitcoin can be better than digital gold. Gold is a bad store of value, right? So if you had bought gold at the early 80s, it would have taken you 20 years to get up to par. And if you had diversified in, S&P 500, you would have had a much better basket, right, to navigate that financial turmoil. So again, I don't think Bitcoin is today an inflation edge. I know it's often a narrative that's used. But what's interesting here is that it is a new type of asset. It is an asset that, if you're in a country where you have a bad central bank, has some very unique properties, and you can access it, you can save in it. We're looking at early adopters in terms of countries that are using it as part of their reserves. And of course, these are the countries that would struggle the most with being and making credible commitments on the international stage to a sound central bank policy. But I think that will continue, and we will see more adoption. And suddenly, maybe 10, 15 years from now, it will become a big piece of the financial infrastructure and backbone. People often obsess about Bitcoin, the asset, but they're not looking at Bitcoin as the global unique ledger that everybody can read and write to. We never had that historically. It's a completely new type of technology. It's a general purpose technology, and like every other general purpose technology that we've seen in the past, electricity, the internet, the steam engine, these take decades, right, to really unfold. So I would look at Bitcoin as really as its new asset class, and I think many in the financial services sector recognize that. Does that mean that the United States should have a strategic Bitcoin reserve? Unlikely. Right? If anything, what's more important for a country that the United States wants to lead, and I know we'll talk more about this, is to really think about these networks that are open and permissionless as really the future of payments, financial services, and kind of our global edge when we're trying to compete with China and many other countries around the globe.
Interesting. Rachel, is that would you agree with what he said? Is there with regards to gold and Bitcoin and that connection?
I mean, I think that when it comes to the technology layer, and I think that what we're talking about in general, right, is a technology here that can do a bunch of different things, right? We're talking about it as a payment rail. We're talking about it as a source of speculation. We're talking about, where does this shift? Where does our regulatory perimeter need to shift for all of this to happen to make sure that we have a technology that is able to flourish within the boundaries of the United States? And how is that supposed to work? And I know that this is running a little bit afield of your question, but I think it's an important one to talk about, particularly with the audience that we have today. Because, we all deal with regulators around the globe, and the United States is a particularly difficult one because there's different purview for different regulators, and the uses of the technology can span a bunch of different groups, all with different mandates. And I always like to talk about Anchorage, and why I'm so passionate about Anchorage is because, we got the first bank, and I never thought it would happen. When we applied for this bank, when the company applied for the bank charter, I was like, this is never, ever going to happen. But it happened. And so you have to think about, how do you make sure that you are able to apply the principles of regulation across a nascent technology? And you don't do that unless you do it. What we've found, and I think that, there are others who have found this as well, is that all of the things that everybody's kind of worried about who aren't practitioners can be solved in the practice. And so, I mean, I know that I'm not answering your question, but it's important to talk about the need for a partnership in the regulatory sphere with practitioners, with operators, to be able to show that we can meet all of the things that you want. You want an anti-money laundering regime? We can do that. You want to make sure that we have appropriate privacy? We can do that. You want to make sure that we have safe, consistent, a resilient payment system? We can do that. If we are able to create an ecosystem that is, that's hospitable to innovators and builders.
Well, why don't we, this is a great subject, and I kind of want to lob it right at Paul. Obviously, Coinbase has been at the forefront of a lot of those battles and seeking clarification. Can you tell us a little more about, I don't know if there's anything particularly interesting about that specific process, as well as what you think good regulation would look like?
Well, I think that in order to understand what good regulation could look like, it's important to really be precise in defining the objective. I think for Coinbase, the objective has always been clarity. Clarity as to the standards that we will be held to, and equally important, everyone will be held to as we move forward with some of these new innovations and products and services. And so that clarity can take the form of, as I've mentioned earlier, legislation, which we believe is the most durable solution to some of the challenges that we all face. It's one of the reasons why we were so and remain so supportive of the market structure bill, the FIT21 Act, which recently passed the House and is now working its way through the Senate. It's one of the reasons why we are so eager to see progress continue with respect to stable coins. I still think there is a chance that we will see progress this year, but certainly in 2025, regardless of the outcome in November, my view is stablecoin legislation will happen, and that will provide clarity as to that important part of the market. But clarity can also come from rulemaking. Clarity can certainly come from the efforts of the agencies themselves to define their jurisdiction and articulate standards that are reliable, predictable, and consistent across regulated entity and different products and services. That's why we have pursued rulemaking, particularly at the SEC, so forcefully, including bringing our own court action against the SEC in order to force it to begin the rulemaking process. And then ultimately, of course, Konstantin, the courts are there to provide clarity in their own right. Now, even though my own background is as a trial lawyer over 20 plus years, I find that regulation by courtroom litigation to be the least satisfying, if only because it takes forever. It takes forever to get to clarity and certainty. And it also is necessarily backwards looking and concentrated on a particular record and a particular set of facts that may not be generally applicable and flexible enough to adapt to new circumstances as they present themselves. But one way or the other, that clarity, which I do believe is the most important objective, can and will be achieved because each of these different options provides their own path and has their own advantages and disadvantages. We've taken the view to pursue all of them, knowing that in one way or another we will get there, and we will achieve the objective that we've sought.
Interesting. And Andrew, I'm gonna I have a question for you that I'd be curious what you think the reason why did Coinbase struggle actually in getting clarity, like on the federal, like what are the downsides of these crypto assets when it comes to ultimately federal agencies, and do you think CBDCs, for example, and stablecoin regulation, are they changing that narrative a little bit?
Thank you. Believe it or not, and this is for the audience, completely not staged because I missed the conference call to prepare for this panel. So this is like completely not staged.
But we weren't going to rat you out.
I know. But I do read the documents associated with the case in the Southern District of New York. They're extremely well written, and here's one phrase. I actually put them in front of students, believe it or not. And one of the questions that they ask, and that's a very important question, at least to me, and that's a question that to me summarizes where I think the difficulty is, and correct me if I'm wrong in stating that, they explicitly ask in one of their documents in the case with the SEC is, where does the software end and security begin? That's a difficult question to answer, and that is the difficulty that is a precise definition of the difficulty, because the software is a bunch of lines of code. It starts out, it's called something, it allocates memory and computing capacity. When do you cross the threshold that all of a sudden it moves and becomes a security, or becomes a commodity, or becomes money, or becomes payment? It was software before, right? And now it's something. Where is it? So when I think clarity is that he's referring to is finding that line. Where is it? Now, to me, that line is kept deliberately fuzzy, because as soon as you say this is the line, people will write software around it. So you will you want to keep it fuzzy, but you want to get the general placement of it approximately there in where this software ends and security begins. Parts of it is what you said. We don't touch customer funds. It's pretty easy. We don't touch customer funds. We are not doing anything with customer money. We're not giving customer advice. We are not in any way saving anything. They come, they ask us to do something, we deliver, we move on. We're Rails, use us. When you're an exchange, people do deposit their customer funds with you. They have to do something. You have to go through, and then the regulators start looking. But it is exactly the nature of that question. And I think that the nature of that question has actually changed a lot. And I would even say it changed very significantly with FTX. And here's why, to me. Because one of the interesting parts about FTX to me, and as you know, on the regulatory side, we were this close to legislation, this close, if not for FTX. Yeah, this close. And then FTX happened, and we don't have it. We may not have it for a while. So what happened there? What got derailed? One of the interesting things about FTX is that in this space of software and digital money, something could exist and not exist at the same time. And that's horrible to regulators, because to regulators, something has to either exist or not exist, 0 or 1.
Well, it existed. It was just commingled and fraudulently appropriated. So, I mean, it's a little different.
It existed, but they didn't know where it was, right? And it was not their money. So, once you go into it, but it existed, they said, that they came in and say, where is it? And they said, well, it's there, but we don't know where. It's like, what do you mean? But like how? It's not a silly question, but it's in the nature of these assets that they could exist and not exist at the same time. You lose your private keys, you look at it, it's there, but you can't touch it. So to you, it doesn't exist, and it doesn't exist to the rest of the to the others. I think that part, that interesting part, is would sort of require a solution. But as I said, it amplified this, I think, for a lot of people. I don't know. I spoke too much as usual.
No, this is super fascinating. Do you have a direct comment? Would you like to?
Well, yeah. I mean, I think of the FTX, and I was like hoping that we could get through like this conference without mentioning them, but
sorry.
But I'm happy that we brought this up, because that that whole issue kind of gets to the heart of where we talk about the regulatory perimeter, right? Because the way that worked is that to be able to trade on that exchange, you're posting to that exchange, right? And people all called it custody. That is not custody. When you're custodying something, right, you are able to show proof of existence and exclusive control over that asset, right? And it's pretty clear in like what the necessity is for custody. That's not custody, that's commingling of assets and like rehypothecation without consent of those assets, right? So those are fraudulent things, and that is, a company where, a lot of different things happen and people are going to jail, but that is not the norm of like what regulated market infrastructure looks like, right? And I think that what we're talking about here is an asset where you can very clearly trace the provenance of, where you can very clearly define ownership of, and that's the beauty of a public block or of a public blockchain. But making sure that we define where the ownership is, what that means, what it means to be in custody, what a custodian is, where the lines between a custodian, a broker dealer, an exchange, and what are all of the requirements needed of that, what needs to be subject to those because of the standing of that asset, and it's a categorization. And so I think that when we're talking about the asset, the properties of the asset, that's not really at question in a situation where we had a fraudulent.
Sure.
claim.
Yeah, but it's a great question, and before I do want to talk a little bit more about the wider payment cycle, but actually, Paul, SAP 21, right? So let's talk about custody and who owns what and stuff. Currently, you guys basically are the custodians of digital assets. Now, there's been a law that nearly got made that didn't pass. Can you tell us about that law, and what does it mean to your company, for example, if it does pass?
Well, you're referring to SAB 121 and the effort of Congress to override that guidance that was provided.
That rule.
Rule is a challenging word in this context, but I'll accept it for the purposes of this discussion. Look, the bottom line is the fundamental problem with the SAB 121 rule was that it essentially imposed restrictions that would make it functionally impossible for many firms to provide the service absent oversight at the federal level, and with no role for the states in that regulatory oversight, and that I think flies in the face of many years of dual oversight that have served the industry and the function well. Coinbase actually was very active in pushing for the repeal of SAB 121, even in some sense as it might serve its short-term interests. But our view has always been that we want to see.
Can you just clarify what that rule would have actually allowed so people understand?
Yeah, well, it would have effectively prevented or excluded from most regulated banking institutions the ability to provide full custody services in a way that would be compatible with customer demands and customer requirements. And so in that sense, as a non-bank, we would face much less competition going forward if this rule were adopted. And yet, our view has been competition is a healthy thing. I think echoing some of the comments of Mr. Chopra and others this morning, this industry, this space, this asset class as a whole benefits from robust competition. And we think most critically, it's important that when we regulate digital assets, cryptocurrencies, tokenization, however you want to label it, that we follow the basic procedural requirements set out by Congress in a way that is expected and performed across a whole range of asset classes and institutions. And so that consistency was very important for us. Now, as it turns out, Congress's efforts to override that rule were thwarted by a veto by the president. And that issue remains very much alive. But I think for our purposes, the main point is we want to see comprehensive rulemaking pursuant to the Administrative Procedure Act and the other requirements Congress has set out. We think we can do this as part of a comprehensive legislative package that addresses not just custody issues, not just stable coins, but market structure, and perhaps even issues regarding AML and KYC at the federal level. But the time to act is now. I think that the urgency cannot be underscored. The rest of the world is not waiting for the U.S. to get its act together. They are racing ahead with standards. And the fragmentation of this marketplace, I think, serves very few. What we want to see is alignment and consistency internationally so that the technology can achieve its full potential. And right now, the U.S. is absolutely at a disadvantage, and it's time for us to address it.
Christian, talking about the U.S., and I think that's a great segue into, what does it mean for the U.S. To, for example, lead in providing payment rails like yours to actually function across the world? Like, how important is this for America, and what's the opportunity here also for the U.S.?
I think it's existential. I mean, if you look at US banks and other financial institutions and their retreat from their global presence in many regions, from LATAM to Africa and Asia, recent news, right? The split of HSBC between a Western and Eastern front. This is the one opportunity the US has to keep leading. A lot has been solved by technology, and I think Paul hinted at this. The technology has reached the scalability levels that we need, the privacy and compliance features that can make it really useful to businesses and consumers. But the last mile hasn't been crossed. So crypto is extremely efficient within its borders. But if the US wants to lead, again, it's not about just picking an asset, even like Bitcoin, and calling it, a day with a strategic reserve. The US, very much like it did a bet on the internet back in the 90s, needs to bet on these open and permissionless networks as the big future of financial services. The future is not Finternet. That vision is as close and narrow as its predecessors. Does anybody remember AOL? Maybe. Microsoft Network? Probably nobody. Or Apple eWord, which lasted only 2 years. Those were all visions for a world that was a lot more closed around the internet. Of course, technologies like TCP/IP and Bitcoin and all the predecessors really showed that these ecosystems work in a fundamentally different way. It's not going to be a consortium of existing banks or institutions. Now, that said, financial institutions have a really important role to play on these new networks. But what is the trade-off? These networks demand for more direct competition. They lower barriers to entry. They trigger a wave of innovation by modularizing things that happen to live together within the same institution, within the same service. Think about credit cards as a bundle of payments and credit. Those things don't need to coexist in every transaction. And let's remember that with the AI on the horizon, and maybe even AGI in a few years, those are very centralizing technologies. AI by design, until we find better ways to distribute compute, to verify computation, and crypto may even help with that. It's something that will give more market power to existing players and existing incumbents. With the interrupt that crypto brings into the picture, we can actually have a decentralizing force and get to a much better market outcome. AI will not care about the technology stack. I strongly believe that the rails will be commodified. And again, we're going to be sub 1 second, milliseconds, fractions of a penny. The assets will be commodified, especially once one stablecoin is as good as the other, because finally we will have regulation in Congress, making them all as safe and sound as they should be for mainstream adoption. And all these transaction financial services will be routed through the cost of least resistance. So that's why I think from a public policy perspective, first, the US needs to lead and needs to continue leading, which requires regulatory clarity. I mean, we've been asking for that in different forms on many of the same panels over the years at this conference. But there's a lot more we can also do on dimensions like KYC and identity. How do you bridge from a digital asset to a traditional one? We need robust controls. We need these payment systems to operate very much like their predecessors. We need to fight, financial crime, terrorism financing, and sanction evasions. These are all really important goals, but that does not mean that we need to recreate some sort of closed walled garden and call it Finternet. I think that's the most important message, especially for this audience. And it's one where if we're not going to lead, somebody else will.
Thank you, Christian. So we're sadly at time. I did want to, throw a silly question, actually at a lawyer, at Paul, like, what do you think the Bitcoin price would be in a year? I'm just always curious how a lawyer responds to a question like that. But you might have to ask him after this.
I will just close by saying I can't comment on the price of Bitcoin, but I am wearing Bitcoin socks.
There you go. There you go.
Draw whatever conclusions from that, what you will.
All right. Well, thank you so much. And I guess you guys be around for questions after. And wonderful. Thank you.
Thank you.
For moderating.